Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and today is April 21st, and I thought I would come to you with a brief market update, as well as talk a little bit about oil, which has certainly been topical here over the past couple of days. As I speak, the S&P 500 is down about 1.8%, down to about 2770 as a level. I say down to 2770. The last market update that we shot was last Thursday. And the S&P was at 2770 on Thursday. So we got a little bit of up on Thursday and Friday, a little bit of down on Monday and Tuesday, and we're right back around the same level where we've been hanging out for the past couple of days. In terms of the fear-greed dynamic that's out there in the marketplace, I think it's really important to understand that the economic data is going to continue to be pretty horrible over the course of the next 6 to 8 months as we go about restarting the economy, as companies report the full magnitude of the losses that they suffered during the shutdown, and as the unemployment claims continue to grow and roll through the economy. However, most market participants are willing to look past a lot of that to where they see the market playing out in 12 to 18 months once more effective treatments for the virus, be it a vaccine or treatment for people who have advanced stages of the disease that reduces the mortality rate, have been developed. To the point where economic life kind of returns to normal. And I think the combination of that vision, that light at the end of the tunnel of economic life returning to normal, combined with the willingness of federal governments around the world to step in and bail folks out of what they see is not a moral hazard problem, but a virus that is, or a pandemic that's beyond their control, is really providing support for investors whose thought process is, if I pinpoint maybe the end of 2021 value on the S&P 500 at maybe 3,000, which is kind of where we started this year, then buying opportunities that come along at 2,500 or maybe even lower are very compelling on an 18-month return horizon. So that return dynamic definitely, for that longer-term investor, definitely exists, and it's providing a little bit of support to the market when the economic data itself looks pretty atrocious on a short-term basis. So with that said, let's spend a little bit of time on oil. Oil made national headlines yesterday when the May contract, futures contract, actually turned negative and got as low as about negative $37 a barrel. That is correct. People were paying you to take oil off their hands. To understand why, it's really important to understand what is a futures contract and exactly how does that work. So a futures contract basically says between two parties that at a certain date specific, one party will give them a physical amount of a quantity, right, of a commodity. So in the case of oil, a futures contract basically says that at some point in May, a date specific in May, the buyer, the owner of the contract, will be taking physical delivery of a certain number of barrels of oil. And those contracts expire. They have an expiry date. The May's contract's expiry date is today. What do I mean by expiry date? Anyone who's holding the contract, the owner of the contract, as of today, is required to take physical delivery of oil in May, right? That's the way the contract works. Now, if you think about that, there are both natural buyers of oil, refineries, primarily refineries and petrochemical companies, and there are natural sellers of oil, namely E&P, exploration and production companies. But there are also speculators in the marketplace. Folks like maybe airlines that want to use oil futures to hedge their fuel exposure. Folks like retail investors that may just want to take a bet on a particular commodity moving up and down. And those folks, those speculators in the marketplace, physically can't take delivery of oil, right? So I get calls from clients on a regular basis saying, hey, can we buy oil? And the answer always becomes only if you have a place to store it when the contract expires. Otherwise, you have to sell the contract before the expiry date, because if you own it on the expiry date, you have to take physical delivery of it. That's the way the contract works. There's no getting out of it. And so yesterday, we wound up with a lot of speculators who owned oil futures contracts that needed to sell them, and a dearth of buyers because the United States is basically running out of storage capacity. Once production starts, it's very hard to turn it off. Once you've got an oil well that's actually, spewing oil out of the ground, it's very hard to shut that in, and there are costs associated with that. Most companies would rather just see that oil continue to flow. And meanwhile, demand is just non-existent because we're all trapped in our homes. We're not driving anywhere. We're not flying anywhere. Heating oil is not really a big thing anymore as we move into the spring and summer. And so, largely refineries don't need it. In fact, a lot of the oil that we're producing right now is going onto ships that are going to take a little cruise around either the Gulf of Mexico or wherever else they might want to sail for a little bit while they hold on to this oil and store it. So as a result, when the speculators were looking to sell those futures contracts, there weren't a lot of natural buyers, and the speculators wound up having to pay people to take those futures contracts off their hands. That is a great example of the types of odd second and third order effects that come about during crises like this. And it's a good reason why you should always make sure whenever you're buying an investment, whether it's an oil future or something else like that, you understand exactly the way that that investment works. So for example, for those of you that have the notion of maybe buying the June futures contract, you should know that you're going to have to sell it in a month unless you have a physical place to actually store that oil. So I would encourage you, if you're thinking about any types of investments in terms of buying the dip on E&P, on exploration and production, just understand how those instruments work before you look before you leap, is maybe a better way of saying it. So with that, if you guys have any questions, as always, please feel free to reach out to me or your advisor. I hope you have a great day, and I'll look forward to talking to you again soon.